Hi, everyone, and thanks so much for joining us today. My name is Mary Ann Hensley, and I'm the Vice President of Marketing here at FreightWaves, and we are excited to be here and happy to present today's webinar in partnership with Redwood Logistics, one of the nation's fastest growing logistics providers, which is fueled by industry-leading technology and a passionate team of experts who deliver next-generation solutions for the industry. Today's webinar has a really interesting and unique focus. Specifically, we're going to be hearing from Redwood CEO Mark Yeager about how private equity companies are disrupting and transforming transportation and logistics today. And FreightWaves Chief Revenue Officer George Abernathy will also be contributing to the discussion. So you guys are in for a real treat. Before we get started, just a couple of quick housekeeping items. First, if you have any issues during the webinar, please reach out to us through the chat function on your Zoom webinar control panel. Also, if you have questions that you would like to ask to our presenters, please enter those through the Q&A box in your control panel, and we'll answer as many of those as we have time for during the Q&A at the end of the presentation. We'll also be sending a link to the recording of the webinar if you'd like to view it on demand or share it with your peers. And at this point, I will go ahead and turn it over to Mark to share his insights.
That's great. Thank you, Mary Ann. And thank you, George, as well. I'm a big fan of what you guys are doing at FreightWaves, and a big fan also of what you're doing with Sonar. In fact, I'm planning to attend your seminar in Chicago this Thursday, if I can get in. But so we'll make enthusiastic about what you guys are doing.
Thank you. We'll make space for you, Mark. Thank you.
All right, fair enough. Just as a quick introduction, as Mary Ann mentioned, I am the CEO of Redwood Logistics. Redwood is a top 20 truck broker, one of the fastest growing 3PLs in North America. We think of ourselves as a unique combination of human capital, financial capital, and intellectual capital. That means we have a highly motivated and accomplished group of people, significant financial backing, and a uniquely effective approach to technology development and integration. Redwood has been in business for just over 15 years. We've grown organically in each of those years. And recently, we've been very active in the M&A space with the acquisition of Simplified, the Phoenix office of Roar, and most recently, LTX. We're now over $500 million in annual revenue. We had a great 2018. We're very excited about 2019, and we probably couldn't have done all that without the private equity backing of our partners, CI Capital. So that brings us to today's topic. Company building, how private equity firms are disrupting and transforming transportation and logistics. So I'll start by saying that there's nothing new about transformation in our space, and there's nothing new about mergers and acquisitions in our space. I cut my teeth in the rail industry, and the year before I was born, there were 102 Class 1 railroads, and now there are 6. And 4 really dominate the landscape. The same has been true in trucking and the steamship industry. They've all seen their share of merger and acquisition activity and transformation. And I'll be the first to say that that hasn't always been pretty. My father, who founded Hub, had his career dramatically altered by the ill-fated merger of the Pennsylvania and New York Central Railroad. Most of you guys are too young to remember that, but that's a merger that would produce the Penn Central Railroad and the largest bankruptcy in US history. But I think when you look at the rail industry and most of the other industries in the US that are related to transportation, the consolidation and merger and acquisition activity has been largely beneficial. Certainly, I would make the case that it's helped the railroad industry. Railroads are now safer, more efficient, better managed, and producing better returns on average than at any time in their history. Now, I don't want to oversimplify that. It isn't solely because of mergers and acquisitions, but I would argue that scale, density, and velocity that were produced by that industry transformation had a lot to do with it. The subject today is more about private equity, right? And clearly private equity had very little, if anything, to do with consolidation in the railroad industry. But private equity has been involved in our space for quite some time. It's not by any means a new phenomenon. Our firm, CI Capital, has been in the space for over a decade. And the number of firms that are in the space now, I think, is one of the things that has changed. It's never been greater. We've never seen more activity going on from a private equity perspective. And that is creating significant impacts on the entire industry, particularly when it comes to asset-light and non-asset-based companies. So when I got into the business, everybody wanted to go public. You know, that was the holy grail if you were a business owner. Now, for a number of reasons, very few people aspire to go public, but many people need access to capital. Many people want to invest in their businesses. Part of the reason they don't want to go public is because it's so expensive, and it's a significant administrative and regulatory burden. But another reason is there's an alternative now, and that alternative is private equity. It's now possible to access capital, even large amounts of capital, through private equity investment. And this is creating, I would suggest, a new dynamic in the industry, with new or relatively small players suddenly gaining access to significant capital for investment in people, process, and technology. Companies that 10 years ago may have been confined to a niche role or constrained in their ability to grow can step up, and they're certainly taking advantage of it. So this first graph demonstrates the number of transactions that have been taking place over the last 4 years. You can see transactions have steadily increased. You'll also see that the multiple is now, well ahead of historic norms. One thing you can't see on the graph, though, is companies that are emerging out of this activity. Companies that were mid-sized companies are now becoming large companies relatively quickly. For example, Global Trans is now a $1.5 billion per year company. The newly announced combination of NTG and TI creates a $3 billion company. My company, Redwood, is now a $500 million player in the truckload, LTL, and transmanagement space. And we're looking to build from there. When we started down this path 2 years ago, I thought $1 billion was a huge stretch goal, but I'm not so sure anymore. The growth opportunities are significant. So what this graph demonstrates, though, is that activity in our space continues to grow. And we've already seen 5 transactions year to date in 2019. Just as interesting, I think, is the mix of those businesses and what's going on, which is depicted in the lower graph from our friends at SunTrust. And what you can see is a fairly consistent pattern from 2015 on of more and more sponsor buyer transactions and fewer strategic buyer transactions, at least proportionately. Now that could change. We may revert back in the event multiples come down. But for now, to say private equity is active, I think is an understatement. Private equity is extremely active in having a significant impact on the competitive environment in the non-asset and asset-light space of transportation. So why is the space appealing to private equity, and why is private equity appealing to business owners? That's what I'd like to spend the next couple of minutes talking a little bit about. So private equity likes the transportation space. There are literally dozens of PE firms attempting to enter the space, and it's for good reason. It's a significant market. I think I was reading on FreightWaves, of all things, that trucking alone is a $726 billion market, as large as coal, natural gas, and oil, and 2 times the size of agriculture. It's an enormous market. It's also a highly fragmented market. Certain areas like parcel and railroading, not so much. But clearly the trucking industry is a massively fragmented market with no player, even the giants, occupying a significant amount of market share in the space. I think private equity firms also like the fact that it's a staple of the economy. It's an absolute necessity. We are a consumer-driven economy, and those goods have to get on the shelves. I think another thing that's attractive to the private equity world is that successful companies in the transportation and logistics space can come in all shapes and sizes. You don't have to be the Union Pacific or C.H. Robinson to be successful. You can grow and flourish at a variety of sizes and with very different models, very asset intensive to completely non-asset based. That's attractive to private equity firms who like to have the ability to pick and choose what kind of companies they invest in and what kind of economic models they pursue. It's a place where innovation is changing the competitive landscape in a fundamental way. I think that the space is really in a state of flux. There's a lot of change going on. And PE firms are accustomed to managing this kind of risk and making smart investments where they think that those changes are going to be in the favor of the sectors that they're examining. Because of all those things, I think it is a fertile ground for new players to emerge and existing players to grow. There's a lot of space for entrepreneurialism in the transportation market. In some ways, it's more crowded than it's ever been. There's no doubt about that. But it's a much less crowded space than many other businesses. And I would suggest that there is a tremendous amount of room for entrepreneurialism in the transportation space. And I think in many ways, tech is changing some of those rules and making it even easier for new players to emerge. New models that couldn't have even existed 10 years ago are now very possible. So in terms of the key attributes of the M&A space on page 7 of the presentation, I think there's a few reasons why M&A is particularly attractive if I'm a business owner. First of all, accelerating top and bottom line growth, right? It's a way to produce growth quickly in a way that would otherwise be almost unattainable. Now, I think while it's the most obvious reason to do M&A, it isn't necessarily and shouldn't be the only reason to venture out and look at mergers and acquisitions as a potential strategy with or without a private equity partner. Many companies, including Redwood, are looking to build scale and critical mass. It's certainly a key driver behind our strategy at Redwood, and I think a number of other companies are pursuing that as well. I think there's a difference here. I know they're both on that slide between scale and critical mass. At Redwood, we're really looking to build critical mass. I don't know that many companies in the asset light or non-asset space have ever achieved actual scale, but certainly getting to critical mass with core service offerings is a strategic imperative, and mergers and acquisitions can help you get there. In our case, we started with an LTL company, Simplified, which had a truckload offering that lacked scale. We combined it with Redwood, which had an LTL offering that lacked scale, but had a terrific truckload offering. So the two were very complementary. So in a single deal, we were able to get to critical mass, both with truckload and with LTL. It also enabled us to provide some additional and new services to our customers. And we think that's consistent with the trend and the feedback that we're hearing from our customers. Our customers want us to be more of a full service provider, to do more for them. They are critically under-resourced and looking for partners who can step up and perform more functions, do more for them as they're trying to tackle their challenges. And the reality is, it's just a hard and time-consuming effort to start a new product or a new service and launch it from scratch. That's something that is beyond the reach of many companies. Accessing new customers and supplier relationships is also absolutely critical, especially right now when capacity development, has never been more important. And as we look at supplier relationships, I think in a world in which, the multiples that we saw on the slide 2 slides ago would suggest that you need to be able to derive synergies from mergers and acquisitions activity. And one of the key ways to do that is through cross-selling. And cross-selling really depends on being introduced to new customer relationships. Adding new talent and expertise, also critically important. We're still in a human business, and a business that's increasingly hard to recruit experienced talent. With restrictive covenants as common as they are in our industry, it's very difficult for executives to move from one firm to another. It's therefore very difficult to recruit experienced people. Mergers and acquisitions are a way to bring on successful, experienced management teams. And it also helps you diversify away from risk. Most mid-sized businesses that we run into have pretty high concentration risk, right? They have issues with being in a single business line or dependent on a single vertical. Clearly, mergers and acquisitions can enable you to diversify away from that risk. So how does M&A drive efficiency and profitability? Clearly, that's a big reason behind many transactions, to become more efficient, more profitable, better able to compete in the market. We already talked a little bit about, scale, density, and velocity. Creating those things can make a huge difference in reducing cost. And I think that technology makes this much more achievable than it was historically. We've all seen acquisitions that were predicated on developing these kinds of scale benefits, and very seldom has it lived up to that potential. But I think with the advent of technology and the convergence of technology, the ability to actually realize those benefits and get up to critical mass is becoming something that's very achievable. Clearly, capturing new products and services, the ability to capture more wallet share, become more strategic with your customers and less transactional, is a way to create a more efficient interaction, and more profitable interaction with your customer. Improved market intelligence and bargaining strength, having a better view of the market, being able to make more informed decisions and putting yourself in a stronger position with your carrier base. I won't say leverage over your carriers, because I don't know that that exists in the current market dynamics, but certainly you're allowed or enabled to make better decisions as you're negotiating cost and price. Building management depth, obviously a way to improve efficiency and profitability. As we talked about, it's critically difficult to find good, solid management teams. And this is a way to bring over, significant talent quickly and efficiently. Bringing new technology and business model improvements. I think what we have found is that when we combined the two entities, what we really were able to do was take advantage of the expertise and the business model that each had created. Simplified had a tremendously scalable LTL model that we had never even considered seriously. And Redwood's truckload business model was fundamentally different than the one being deployed at Simplified, and the two businesses really benefited from that combination. Clearly, access to capital. I do believe that a good, solid private equity partner is going to leave room for investment in the business after a deal closes. So there's the opportunity to then not just bring two companies together, but then invest in the combined whole. And then finally, eliminating redundancy. I would suggest that that's always on the list. It generally consists of backroom functions. but I think it's at the bottom of the list for a reason. I think it's a nice to have, but it shouldn't be the driver of any particular acquisition. So if we take to the next slide, talks just a little bit about how suppliers and customers can capitalize on these changes. You know, clearly, mergers and acquisitions can be disruptive to customer relationships. They can be disruptive to carrier relationships. So I think it's important that if we do have customers or carriers out in the audience, that they think through how they're going to approach the newly combined entity. And I think in both cases, it's really about having a good informative dialogue with the new company. It's important to understand the new organization, to understand their strengths and weaknesses, to establish on the customer side a commitment to continuity and customer focus, right? It's important to reinforce that you're not going to see disruption and to have that commitment from your underlying provider. This is also the opportunity to articulate, you know, how you want to do business with the newly formed entity. What's the best way for you to interact with them? This is a chance to change some of the things that you might find to be inefficient or things that were not optimal. And then I think if you seriously consider the new capabilities of the new organization, that will go a long way in aligning your interest with the newly combined organization. From a carrier perspective, hopefully it's viewed as something that's positive. It's really an opportunity to do more. This should be viewed, you know, as a very good thing. It's a good idea, though, to get to know the leadership and the decision-making structure. You don't want to be caught off guard if things have changed. You want to understand the goals and priorities, just as was the case with the customer, and explore the opportunities to align and integrate. Is there a chance for you to get closer to the customer? Is there a new technology that's being brought to bear that really allows you to streamline communications and actually integrate in a meaningfully differentiated way? So what are the implications of all of this? If we truly have, you know, companies that now have significant financial backing that are going to be active in the merger and acquisition space, I think one of them clearly is we'll see more and more businesses swiftly accelerate much more rapidly than we did historically. Businesses can now get to critical mass much quicker, and they can access capital much more quickly and readily as well. So that's going to enable them to come up the curve, to become a player in the industry much more quickly than historically would have been the case. There will be winners and losers. Not every deal is going to work. There's been a lot of deals. Many of them make a ton of sense, but not all of them will be successful. I think we're really going to see technology as the very real differentiator here between which deals do work and which do not, and who emerges as a significant player as a result of all of this disruption in the market. I think that going forward, you know, those that can invest in technology will, and with this change in the landscape, more and more companies who maybe ordinarily would not have been in a position to invest in technology are now able to do so. Multiple models will emerge. I don't think, you know, we end up in a one-size-fits-all world. I think the models that emerge from this over the course of the next 5 to 10 years will be different. But I also think we'll have different models, right? There won't just be one model that carries the day. And then the last bullet point, existing players must and will adapt. By and large, despite all of this disruption, I do believe that existing players who are thoughtful and investing in their businesses will adapt to this changing environment. And I seriously doubt that we'll see significant displacement of industry leaders. So that takes me through the slides and opens us up to questions.
Awesome. Thank you so much, Mark. That was super insightful. And I know that George is bursting at the seams with some questions of his own, so I'm going to turn it over to him here in a second. But to those of you listening in, feel free to send your questions through the Q&A button in your control panel, and we'll get started on responding to those here in just a moment as well. And George, for now, I will turn it over to you.
Thank you, Mary Ann, and appreciate the opportunity. Thank you to Mark and the Redwood team for doing this. My enthusiasm for the topic is significant, as well as for what Redwood is doing. So, Mark, let me ask a few questions and see if we spur any other thoughts from these. But you've made great points around why transportation is attractive to private equity. And at Redwood and your partner at CI Capital, I've got background with CI Capital, having worked on 3 acquisitions in my past with them. You guys have obviously been active in the M&A market. You know, in your slide, in your graph, you showed the multiples and the differentiation between sponsors and strategic, but how is you guys are as active as anybody. How is the market right now? Is it evolving from where it was in 2018? And I'll follow up on that about how you're figuring out the right opportunities. But how do you see the market today, and is it evolving at all from 2018?
Yeah, that's a good question, George. I mean, I think that it's a little early in the year to tell whether it's evolving from 2018 or not. I think what we saw in 2018 was a very active market. You know, as you can see from the slide, a lot of deals, multiples did move up somewhat. Some would say that they were a bit on the inflated side. I'm not sure about that. I think what you saw in 2018 was high multiples for high quality companies.
Right.
But the reality is there's just a ton of private equity money out there. There's a number of private equity companies who really want to get into the space and have not been able to do so as of yet. So I think what we're going to see in 2019 is a very similar pattern to what we saw in 2018, and that is a lot of folks looking to get into the space. It wouldn't surprise me at all if we do see some strategics jump back in. I can't imagine that Brad Jacobs is going to stay on the sidelines for too long, but you know, he's going after very big fish. But I think some of the other players will probably want to jump back in as well. Particularly true if money gets a little bit more expensive and has, you know, some type of effect of bringing some of the multiples down a little bit. But you know, right now what we're seeing is robust activity. You saw a number of deals close in 2009, and I think it's going to continue.
So talk about the deals in particular, and you are obviously active. The evaluation for those right opportunities. Do you have anything constructed formally, or do you, as you consider your acquisition of Simplified? Obviously, you well described the truckload and LTL, and really putting together a package that has you know, huge customer value benefit. As you evaluate the deals, how do you think about adding to your portfolio, adding to your arrows in your quiver, compared to where that multiple is going to be, and how hard is that needle to thread?
It's a challenge. There's absolutely no question about it. There's just no room for error, you know, at these kind of multiples. You have to make sure that the company is going to be a good fit and is going to really bring, you know, good value. So, you know, for us, we're a little different than some shops, and different private equity firms look for different things. But, you know, we look for solid, focused companies. We want businesses that are, you know, consistently profitable. We really want to see a solid management team. That's critically important to us. Not that, you know, if an owner was planning on completely, you know, disengaging, that would not be necessarily a deal breaker for us, but we really want to see management continuity. You know, CI Capital has a phrase they call management back, buy, and build. So they really want to get behind management teams and help them to grow the business. So that's an important part for us. And I think that the other thing that really, you know, is overlooked all too often in the process, but that's a major part of our criteria, is cultural alignment. You know, we have a really unique culture here at Redwood, and it's really important for us that any company we look at, we think is going to be consistent with that culture, and we're not going to have to fundamentally change a culture or see, you know, some kind of discord. So that's probably the toughest thing to evaluate because it's hard to put onto a spreadsheet, but at the same time, it's critically important.
Understood. I'm glad you brought up culture. I was going to talk about that, and you're right. Trying to figure out, trying to quantify, trying to put a metric around that, trying to think like a row or a column on a spreadsheet is challenging. Well, let me talk. You talked about technology a little bit. Obviously, your technology, the technologies that you've acquired, broaden customer value. But how do you evaluate your own and how much you need to invest in your own team to be thinking about how those technologies will be integrated, and how important is it for those technologies to be integrated?
Yeah, I mean, we really, always hope to find, in a potential acquisition candidate, good solid technology, certainly, something that would be additive to us, right? We feel like we have a really good technology stack. We're in a very good position. We have a very nimble architecture, and one of the reasons we've architected our system the way that we have is so that we can plug in technologies either from an acquisition candidate or from the outside world. So it's an architecture that was specifically designed to enable to incorporate other approaches and other applications into our core operating system. And so far, it's been pretty successful, and we have been able to follow that path. And I think we've really come up with a solid integration of Simplified and Redwood. And I think with LTX, we'll be going down a similar path.
I wanted to go down the road and looking at some of the Q&A from folks, and thank you for providing these. There's some overlap on some of the things I want to talk about, Mark. So let me ask one of these. So there's obviously the mechanism, the methodology, and the process that you and CI are following, and you have alternatively the technology digital brokerage companies that are raising significant funding. Does that change at all the landscape for what you're looking at? Does the multiple go up because others are raising funds so obviously, or are they relatively separate?
Well, it's hard to say. I mean, we're certainly in a similar space, and I think part of our strategy once again is to tap into the best technology that's available out there. So if we are able to capitalize on whether it's workflow automation, artificial intelligence, machine learning, those kinds of things, those are definitely investments we'll make both organically and also potentially through acquisition. So we are mindful of what's going on in the space. We want to make sure that we stay current, and we want to make sure that we're able to adapt to whatever technology does emerge and access whatever technology emerges. At this point, we think it's also still very much a people business, and we are unique in that I think we have really forward-looking technology, but we also have a tremendous team of experts who can really make the most of the technology that's available to them. And I think that is a unique position for us. I hope it helps with how we're viewed in the marketplace and the value proposition that we bring to our customers.
That's really interesting. Another one from the audience I think is interesting. You talked about the process. You've talked about how you value and how you're trying to put the puzzle pieces of the acquisitions together. But are there any obvious, beyond kind of what you talked about already, maybe around the additive technology and culture, but are there any specific warning signs that you would suggest should cause folks to run away from certain deals?
Well, like I said, one of the things we certainly look hard at is management continuity, right? We want to make sure that, that the team is wanting to come on board, that they're engaged, that they buy the thesis, and that they really, feel good about it. I think you also get a sense early on as to just how engaged the team is. And at those first few meetings, do they know their business? Do they know their customers? And do they know their carriers? And sometimes as businesses get older, they lose touch a little bit or aren't as involved in the day-to-day. And for us, we want really engaged teams, folks that are all over their businesses. Personally, I like a business that's focused. I don't tend to migrate towards businesses that try to do everything. I'd rather have them do one or two things extremely well, because I think that's what's going to strengthen our business.
Interesting. A topic that I have some level of interest in personally, having spent a fair amount of time in companies that work with private equity partners, is the different goals that venture capital and private equity have, and oftentimes the two descriptions are thought of very similarly, but in a venture capital based company, usually or almost all the time, growth at the top line is what the targets are. It's what your damn the torpedoes, full speed ahead. But you live a lot, Mark, in that private equity world where EBITDA is king. As you're looking at making acquisitions, do you find that companies that are growing for growth's sake and may fit all the other parameters that you have for a deal, that there's any difficulty in flipping the switch from that grow for growth's sake and thinking about then what EBIT is, or is the one for all for one usually taking over once you bring the cultures together?
Yeah, we have not gone down that path in terms of making an acquisition in what would be a startup, at this point. I would totally agree with your point that the focus and the emphasis is fundamentally different between private equity and venture capital. And there is a huge emphasis on two things really in the venture world, it seems to me. One is exactly as you said, top line, right? And the other is the strength of the management team. You're really, in many cases, I think, making a bet on the management team. Hey, management team's super important to us. So in that sense, there is a lot of crossover, but we need to be able to see that this is an idea that can bring EBITDA, right? That can contribute to the overall business, as opposed to simply establishing itself on the top line. So for us, it's very important that a business be thinking about how how it grows its profitability. And we would have a very tough time, I think, even considering acquiring a company that could not, point to a near-term path to profitability.
Gotcha. Let me take one that came in from the audience in talking about the non-asset service sector, the non-asset players like you. The technology is oftentimes proprietary, and within PE activity in this area, are the PE folks really, how much, as you look at the acquisitions, how much is trying to buy technology that is a differentiator? You've talked about AI, you've talked about elements like that. You've got to check the technology box, but how much is what's new and different and cutting edge is in your consideration?
Oh, I think it could be a huge positive, right? There's no question about that. And more so than it probably ever was, right? I think across the industry, people are putting more and more emphasis on where are you at from a technology perspective. It's great if there truly is something new and innovative. If there isn't, then you have to ask, okay, where are they at? And what kind of additional investment are we going to need to get to that level of differentiation? That's one way to look at it. And the other way to look at it is, okay, if they're not where they need to be, by coming onto our technology, will they have a substantial benefit? And I think there's a lot of opportunity there because we do have a really, solid technology platform. that we can plug a less efficient business into, not immediately, not day one, because those things are never easy, but we have the ability essentially to make them more efficient by bringing them onto our system in many cases.
We're working our way towards getting to the final questions. I've got one more. As you think about what's next, the arbitrage opportunity is much more challenging today than it ever was. So, what's two questions, Mark? How big can a company like Redwood, how large can your pursuit portfolio be? How many at one time can, a company now with $500 million worth of revenue, with $1 billion in sight, how many pursuits can Redwood have at any one time?
Yeah, that's a good question, and it in some ways depends on which ones they are, right? I mean,
right.
There's a difference between pursuing, 3 brokerage companies and a trans management company, a knowledge services company, and a brokerage company, right? Because you sort of have different business resources. I will say that I think that, one of the real benefits of having a private equity partner is that's a part of the process that they are tremendously helpful with, helping you source deals, helping you, early stage evaluate whether there's a fit, helping you build, a due diligence plan, and then really, helping you build an integration plan. We could have never gotten the things accomplished that we got accomplished in the course of the last 2 years without CI's help. I tried to do that, in a prior life without that kind of assistance, and it's much, much more difficult. So, I feel like at this point, we are just onboarding LTX, and we're super excited about that. But we're active in the space right now. We feel like we could definitely bring on some more, certainly some more deals under consideration, but we feel like we could actually onboard some additional businesses potentially. So we'll be in the market pretty actively throughout 2019. I wouldn't put 6 deals in the pipeline all at once for us, but we can certainly handle several.
Excellent. Well, I want to thank Mark and the team at Redwood. This was fascinating stuff. It's something that I think by the demonstration of the number of participants showed that we had a very interesting topic today, and Mark and the Redwood team exceeded my expectations, and I set the bar very high. So Mark, thank you. Jake and the team out at Redwood. Marianne, back to you.
Awesome. Just to echo George, Mark, thank you so much for being here, to Redwood for being our partners on this awesome, timely webinar topic. We appreciate all of you in the audience for listening in and for providing your thoughtful questions as well. And that will conclude our presentation for today. So thank you all so much. We hope you'll join us again next time.
Thank you.
Thanks, guys.